All right, Casey Chohan here, founder of Together CFO. New year, new start, tax savings in 2026. Going to be proactive rather than reactive. I'm going to show you some structures that can save you anywhere from 30% up to 60%. Let's get into it. All right, so we're going to save you a lot of money today. Let's show you how it's going to happen. And again, we're creating a lasting family legacy. Everything we're going to do and talk about is a long-term plan. It's not designed to be a short-term fix. So keep that in mind. All right, three things that we're going to look at. So the three options today are a donor advised fund, number one. Then we're going to look at a private foundation, number two. And then the best one, right at the end, obviously, is a strategic giving partnership. So with a donor advised fund, you can get up to a 60% deduction on your taxes. With a private foundation, you can get up to 30% deduction. And a strategic giving partnership, you can get up to a 50% deduction. So anywhere from 30% up to 60% on tax savings. That's what we're going to get into. Let's go. And let's start by reminding you what the true tax rate is of these elite billionaires, right? So these elite billionaires all pay less than 1%, other than Elon Musk, who's a little bit more generous. He pays 3.26%. This is all based on their leaked tax returns. Type in ProPublica billionaire tax, and you'll get this article that shows this image on the screen, which is ridiculous to think that these guys are set up in such amazing structures that they can pay less than 1% tax and be billionaires and make all this wealth, yet you're stuck paying 30, 40, even 50% taxes and no chance of making any real wealth because half of it is gone or a third of it is gone instantly to Uncle Sam. So what is the mission of Uncle Sam is to pay your fair share. Why should their fair share be 1% and your fair share be 40%? I don't think it should. I'm going to show you how to save that now. Again, this is not loophole level stuff that we're talking about. If you're paying less than $200,000 a year in taxes, loopholes are great. You should start there. A lot of them are free, easy to use. If you're paying over $200,000 a year in taxes, this is the video for you. We're going to give you some options, give you some education, give you some things to go research and read up about. Again, everything is all education purposes only. Do your own research. Okay, so we want you to be of a growth mindset, be proactive rather than reactive. If you're only sitting with your CPA once a year, you deserve to pay a lot of taxes because you put no effort and energy into proactively saving money, right? And then that's taken away from you and your family. So that's on you really to do better, have a growth mindset, be proactive, prioritize taxes now while it's quiet, because when it gets later in the year, there's a million things that are going to come up. So we always want you to have a proactive mindset. Not for us, doesn't benefit us, it's for you, right? And again, Bruce Lee, one of my favorites of all time, he says, I fear not the man who practices 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. So really, if you become a master of that one kick and you've done it so many times, he's really going to fear you, and you should be scary at that point because you're going to be a master, right? Ultimately, what he's saying is do one thing really well, master it, and that's when you become really powerful and people become scared. I'm going to show you three things, one of which is the main thing, strategic giving partnership. And it's the same as a doctor. If we use a modern day analogy of that, right? If you go see your general practitioner doctor, he might know a little bit about a lot of things, whether you've got a back pain or a neck pain, what to do, what cream you need. But if you go see a brain surgeon, on the other hand, he's a specialist. The only thing he's interested in is fixing that brain, and that's all he does all day, every day. So if you've got a specific need, i.e. tax savings, you got to go see the tax savings specialist that's going to do that, not a regular CPA, because the CPA is a generalist. CPA's job is to make sure you file and pay your taxes. CPA's job is not to make sure that you save as much money as possible. That is a tax specialist, a tax strategist, someone who's actively trying to save you money. Is different than your CPA, right? So your CPA is a cost center. He is going to get the set amount of money regardless of how much he saves you. If he saves you $1 million, he's still going to get $5,000 a year. If he saves you $5,000, he's still going to get his $5,000 a year. Whereas a tax strategist is a revenue center, because that person is saving you money, which is the equivalent of you making more money in your bottom line, right? So don't get it confused. And they're also then incentivized on saving you money. So the more money they save you, the more money they make. So they're going to be on the same side of the table as you, as opposed to the CPA, who doesn't really care, just gets paid on you filing and paying. So make sure you understand the difference between a CPA and a tax strategist, because 90% of people overpay on taxes. Likelihood is you are one of them. We don't want you to be, so you better set up a call with us and we'll show you how much you've been overpaying and how you can stop that overpaying, more importantly, right? So Money Calculator, giving you an example of the strategic giving partnership. We'll get into this later on in more detail, but generally speaking, you can save 50% a year on taxes and then also grow wealth at a ridiculous rate as well. So how does this work? In the current situation, let's say you've got a $5 million company, $2 million profit, and to make things simple, you're paying a tax rate of 40%. So you've paid $800,000 a year in taxes, right? With me so far? And then if you had the strategic giving partnership, same numbers, let's use $5 million in revenue, $2 million in net profit, your tax rate can be reduced by 50%. So you'd go down from 800,000 down to 400,000. And then another kicker of the strategic giving partnership is that half of that net profit can also go into the partnership and grow in a very tax-friendly environment, right? So you've got $1 million sat there growing wealth, and you've saved $400,000 per year, or at least in year one, on straight up tax cash flow. So it's a win-win here. That's a great scenario. And you can do the math. You can just flux it for your business, but you get an idea of how powerful this is. It's a 50% saving on taxes day one, and then 50% of your net profit into growing wealth and accumulating wealth. This is the difference from being rich to being wealthy, right? This is the types of structures that we're talking about today. And what would you do with it if you had an extra $1.4 million a year to play with? Would you buy real estate? Would you buy stocks, crypto, precious metals? Silver and gold is going up like crazy right now. Would you issue hard money loans and get an even bigger return? Or would you buy government bonds, depending on which government and how much you trust the government? But plenty of things you could do that 1.4 million to then grow and extrapolate that. And if it's done in a tax-friendly environment, again, you're saving more and more money, going from being rich to being wealthy when your money is working for you, making more money, right? So let's get into it. The DAF, Donor Advised Fund. What is it? What's good? What do you need to know? So good thing about a donor advised fund is you can get a 60% donation deduction when you issue money to a DAF. So that's fantastic. It's a really high number, right? So you can reduce your tax rate a lot. The issue with it is you cannot control the funds. So let's just say you got $1 million net profit. You can take 60%, put it into the DAF, 600K, but you have to let go of those funds. You no longer control those funds. You cannot benefit from those funds. You don't have to issue the donation instantly. It can stay in there, but it would be your wealth manager that would control those funds for you. Well, not for you anymore, because you've given it away. You're giving it to the donor advised fund. So if you want to keep control of your funds, this is not a good solution. If you actually want to just give to charity, get a tax deduction now, but you don't know which charity or when, then a donor advised fund is pretty solid for that. So again, the key factor here is the control. If you don't want to give up control, don't do the donor advised fund. If you're happy to give up control, then a donor advised fund is for you. Private foundation, number 2. Okay, so private foundation is awesome as well. So here it's up to 30%, right? So 30% of your net profits. Again, let's use the $1 million example. 300,000 of it can go into the foundation. Issue is you cannot use those funds personally, right? You're classed as a disqualified person once you donate into a foundation. So you can't then use those for personally. Self-dealing, can't give yourself any insider deals, none of that jazz. But also that extends to the people around you. So the stakeholders of that foundation. So anyone who's donated, anyone who's part of the foundation who works there, then their parents and their kids. So a linear line in family. Now, where it you can kind of get a little creative with this is brothers and sisters, siblings, right? So the disqualified persons goes up and down in a family lineage, right? So if you donate in, then your parents and your kids are disqualified as well. They can't participate or can't get a benefit from this foundation, but your siblings can. So if you donated in, you could still potentially issue a loan to a sibling if you wanted. Again, tricky. I wouldn't advise this one if you want to keep control of the funds or use them personally. But it's good to know private foundations are really solid if you do have some philanthropy you want to do. Again, this can get split into operating and non-operating. Again, lots of terminology in there, but effectively you can grow with no capital gains tax and pretty much tax-free is 1.4% tax rate here on any dividends and things that it is produced. So it's very, very low tax environment. So it's fantastic for that. No capital gains, amazing. So private foundation, something to consider. Definitely look it up, read about it, learn about it. Only 30%, so it's not great on the amount that you can deduct, but a good entity to know about. And the most important one around strategic giving partnership, right? SGP. And again, what's this based on? It's based on ownership versus control. John D. Rockefeller, the main man himself, he said, own nothing, control everything. I'm going to say that again because that's a really powerful statement, often overlooked and not really understood. Own nothing, control everything. So when you look at these yachts that are parked out in Monaco, a 100, 200-foot yacht, do you think that the billionaire who owns that yacht, it's in his name? Absolutely not. Absolutely not. Right? It's some trust that's offshore or a company operating here, there, or anywhere, some unknown country. It's never going to be tied back to him directly, right? And that's because he doesn't want to show you that he owns that asset. But he's the one calling the shots, telling the chef to make him a lobster dinner, right? So he controls everything. So if you can get really comfortable with this philosophy, this mindset, it's really going to help you accelerate wealth a lot quicker because you want to turn into a ghost, right? Effectively. That's really what he's saying is if nobody knows what you have, it's going to be really hard for them to come and take it from you if they don't know what you have. But if you can control it, use it, enjoy it, it's two different things, right? So we want to make sure you understand that. Again, ownership and control, we went over that. And here's an example of ownership versus control. So right now, current, on this top row, currently you have 100% control of your entity, you have 100% ownership of your entity, and your tax rate is really high, right? That's why you're watching this video. Now, in the strategic giving partnership, it's split between your new situation and a nonprofit as another partner. So in the new situation, you still have 100% control. The nonprofit has 0. But the ownership is switched. This is the key, right? This is what Rockefeller's talking about. So he's like, in the new situation, your ownership goes down to 1%, and the nonprofit is at 99%. And now your new tax situation is extremely low because now you're only getting taxed on the 1% of profits that are made because you only own 1%, but you control 100%. So if you can get a scenario designed like that, where you have complete control of everything, but no or very little ownership, that's where you can get into a really low tax state. And that's what we're going to show you. Case study of how this runs. Mr. Lee owns a company with $2 million of profit, living in California, pays a boatload of taxes at $800K. By donating $1 million to the Strategic Giving Partnership, he was able to save a fortune, right? So he saved $400K year one on his taxes as a hard cash flow saving. But on top of that, he still had that $1 million that he controlled. So $1.4 million gain by doing that, all on a $2 million profit. So pretty impressive in terms of how efficient this is. Again, not just small businesses, but we helped $12 million manufacturing company in Texas save $1.2 million on taxes. They didn't need to pay anything just because they structured themselves correctly, or just more efficiently, not even correct, right? More efficiently. As you scale and grow, you need better systems and processes. So now, if you're sticking around at this point, you might as well set up a call, free call, see how much you've been overpaying and show you how to stop the bleeding. Stop that overpaying. About us, I'm Casey Chohan, founder of Together CFO. We've helped nearly over 300 companies save millions of dollars on taxes. I've spoken on loads of different platforms all over the place. Scan that QR code. Let's set up a call, or you can give us a call or a text or an email, whatever you want, right? We're here for you, help educate you, save some money. Remember, it's not how much you make, it's how much you keep that really matters. KC, peace out.